So let's look at private debt, part of private equity. This is very simple, not too important if I can say so. So basically private debt is when you're investing into debt, when you're lending money to private companies. That is your private debt. When you're looking at bonds and all that are trading in the market, that is public debt. Private debt is, it's obviously not trading in the market. People cannot buy, sell from each other. It is not being traded in the market. So what are the different modes of private debt? Distressed debt is going to be very interesting. So one is direct lending. Direct lending is where you're investing without an intermediary. So you're giving the loan to the company directly. Normally the lending and all happens through either a bank or something, but here you're saying you're directly investing into the private debt of a company. You are giving money to a company. It could be a leveraged loan. Let me do a sum and explain to you what a leveraged loan is and how does it work. Say for example, sorry, private equity, private debt firm. Say suppose private debt company lends $10 million to a private company X. Normally, when you're looking at public debt, if we people invest in bonds and all, let's say the interest rate or the rate of return would be somewhere close to 7% or so. But obviously, when you're lending to a private company, it is riskier and it is less liquid as well because private debt is not trading in the market. So the returns should be higher or lower? Higher. So let's say this $10 million is going to fetch a return of, let's say 8.5%. Okay, this is fine. Now, let me make this a little more interesting. Let's say this is $100 million. Okay, my calculations will become simpler. Let's say I'm looking at an alternative where I want to invest into a leveraged loan. Leveraged loan would mean that this private debt company is going to borrow 50 million, let's say at the rate of 6%. I am borrowing and I'm going to lend this 100 million again at 8.5%. It's a leveraged loan because I'm borrowing, I am leveraging and then investing, I'm borrowing and investing. 50% of the investment I am sponsoring myself, 50% of the investment is from borrowed money. Ultimately, own investment is 50. On this investment, the private debt firm is earning 8.5%. But over here, what is the return of the private debt firm? Private debt fund is getting correct? 15 to 6%. How much is this? %11 is a return. Earlier you were earning 8.5% on your capital. Now what is happening? I am earning 8.5% on my $50 million, but on the $50 million that I have borrowed, I am earning extra 2.5%. That is getting added and giving me an 11% kind of return. I am magnifying my return. Obviously the risk is more because if the default happens, if this guy defaults the first 50 million, the entire default is going to be borne by you. Because you took a loan, you are responsible for making this payment. But you've taken a risk of $100 million. You've invested 50. But if this guy, say for example, this guy pays 0, you will have to pay 50 out of your pocket. Not only do you lose your $50 million, but you'll also have to make a compensation of $50 million. Your loss is not 100%. 50 million is not your loss. Your loss will be 200%. Think about it. If I'm investing 50, I've given a loan of $100 million. If this entire $100 million is total loss, you get 0 for this. You've lost 50 million or you've lost 100 million. You've lost 100 because you'll have to pay this guy 50 as well. Your loss is not 100%. You did not lose 50 you did not lose 50. You did not lose 100% of your investment. You lost 100. You lost double of what you invested. You lost 200%. Your loss is minus 200%, not 100%. Are you understanding? So you can borrow and lend. So this is leveraged loan. I have borrowed and then I have lent. That is to magnify my returns. And obviously, both positive and negative get magnified. There is higher risk involved. Tell me, following this, you're investing into the debt side of venture capital, not preference shares, convertible debt. Normally, obviously, I've already explained this part, that why would you want to invest debt into a venture cap? When the risk is high, it does not make sense. So when would you invest? When you have a convertible debt or something, wherein you can convert your debt into equity shares. Or if you have attached warrants, warrants is something you'll study in fixed income. Sorry. So basically what happens is venture capital companies and all, in order to raise money, because obviously nobody would want to lend debt to a VC. In order to attract investors that know you want debt capital, maybe you are in a relatively later stage of your startup wherein you know that you have cash flows and you'll be able to pay off. You're confident. You want to still issue debt, you don't want to dilute your stake. You don't want anybody else to become an owner, you don't want to give away equity stake in it. You can issue debt with attached warrants. So warrants basically gives the right to the investor that you have the ability, you can give me this much money and you have the right to buy shares. So you get that, that access to shares. You get that possibility, you get that opportunity that you'll be able to purchase shares at an X price. So warrants is something covered in detail in fixed income. Think of it like a convertible kind of security, a security that gives you the option to buy equity shares of the company later. Because ultimately, if the venture cap is successful, I would want to participate in that. Otherwise, it makes no sense for me to take risk and invest in debt. If I won't enjoy the upside, why do I want to invest such a risky security? Tell me, are you following this? Getting the idea? Next is mezzanine debt. So mezzanine is basically when you're looking at bonds and all. So normally you have senior debt, you have junior debt. So senior debt is basically when if the company goes bankrupt or if the company defaults or something, then the company's assets will be sold off and first the senior debt will be paid off. Then if the money is left, then the junior debt gets paid off. So you might be investing into mezzanine debt that is subordinated to senior debt, subordinated to senior debt. It could be subordinated to senior debt. Why would you invest in mezzanine debt? Because again, very often it is going to be either convertible or having warrants attached. That means there is a possibility you can convert it into equity. So you're taking risk. Of course, if things go bad, the company goes bankrupt, but still after senior debt, you will be paid first, then equity. So there is an advantage here. And if the company becomes very successful, I've entered into a risky debt. If the company becomes very successful, I can convert it into equity. Are you understanding? Again, see, every investor will have his own preferences. Every investor will have different requirements for risk and return. So depending on what suits you, it's possible you may not like this option and you want to go for pure equity. It is possible I want to go for debt because maybe in equity it is too much risky. At least if the company goes bankrupt, at least I'm going to be the one who's going to be paid first before equity. So maybe that is the reason why I want to invest in debt. So it will totally depend on your expectations and your risk return requirements and all. Tell me, comfortable? That is your mezzanine debt. Distressed debt is when a company is in absolutely almost at the stage of bankruptcy or it has already gone into the phase of bankruptcy. Bankruptcy proceedings, etc. will start. Over here, what happens when you're looking at the bankruptcy part, that very often, I've already mentioned this, very often the prices go below the fair value. So when you're looking at Kingfisher, Jet Airways, so we've seen these kind of situations happen. In case of distressed debt, in case of this bankruptcy kind of a situation, what happens is, say suppose a company had a $100 million debt. Now that value of that debt has become $20 million, $80 million wiped off. Right? Because it is a distressed company almost at the verge of, or it has already gone into a bankruptcy proceeding, the defaults and all have happened. It is possible that you might be able to sell off the asset at 30 million. You see that opportunity, you want to buy 20 million worth of debt. The problem is that certain investors may not be able to remain invested because it's too risky for them. Also what happens is there is no guarantee that you will be able to recover 30 million. Court case, bankruptcy case will go on. It might take a couple of years for you to recover. Private equity funds, private debt funds are specialized to handle these situations. They are risky ones because ultimately who invests in these private equity, private debt funds? The investors who are willing to take that kind of risk and who have that risk appetite and they understand the risks and they have that kind of money to invest. So I'm trying to take opportunity of such a distressed debt situation. Also what happens is when a company goes into a bankruptcy mode and this kind of a situation, there are a lot of debt covenants triggered. So a lot of clauses in the debt contract gets triggered. Say for example, if you default on your home loan, what will happen? The bank will say that no, you have to get out of the house is our property now. They will have control over the asset. There are certain provisions that will get triggered, right? Then paperwork, court case, etc. can go on, and then you have to pay foreclosure, whatever, and get your house back. But here in this case, what is happening in case of distressed debt? Here you will become active. Here also, if a company is defaulting and all, there are provisions that will get triggered. The debt holders might get, okay, if you are not going to pay on time, we will have 2 seats on the board of directors. Maybe the debt holders will gain control of the management. They will get more powers. You will become more actively involved. You will try to restructure the company the way you want, because you have invested $20 million. You're gaining a good amount of stake. You have a bargaining power, because you can tell them that no, I'll take you to court and I'll make you bankrupt totally if you do not pay my money right now. Otherwise, you listen to me. So again, debt agreement will have certain clauses that in case the company is not able to pay, you will get a lot of say. You will have a lot of bargaining power with the company. You will have a lot of bargaining power. Think of it this way. You'll have a lot of bargaining power with the company. You are actively going to be involved. It is not that I bought the share, prices will increase, I'll sell it. You get actively involved. Private equity, private debt, throughout you are very actively involved in the business. When we study hedge funds, you'll understand this is a stark difference. In hedge funds, it's more of you don't get involved in the management or the operations and all of that. But when you're looking at private equity, private debt, venture capital, etc., you have major involvement in the operations of the company and all. Tell me, are you following this? There could be other ways also of investing into debt. It is possible that you might, a company, a venture capital, a PE fund might invest into both debt and equity of the same company. So you might have bought shares also, and you might have given loan to the same company, to the same portfolio company. Tell me, possible? Comfortable? Easy? Also, that I was doing a sum. Now when we're looking at the benefits and risks of private equity and private capital. So private capital basically consists of both private equity and private debt, right? So private equity, when you're looking at, the benefit is obviously the return of private equity is higher, quite higher as compared to the return on equity. But obviously the risk is also much higher. Higher return because of higher risk. In the long term, if you're looking at a longer term duration, 10-year, 20-year kind of horizon, we would notice that the return of private equity is higher than that of return on public equity, listed equity market and broad equity market and all. Correlation, I'm not saying correlation is low, please understand. The correlation is not very low. The correlation is not negative, but the correlation is definitely less than 1 between equity and private equity. There is diversification benefit, but not too much. There is a decent amount of diversification benefit. We are not saying that the correlation would be 0.2, 0.1 or so. The correlation could be 0.6, 0.7. Whatever, even if the correlation is less than 1, there is diversification benefit. We do the proof of all these things in portfolio chapter, right? So correlation less than 1, there is diversification benefit. They don't move exactly in the same manner. So there is, even if they move a little bit, they don't move exactly opposite. They don't move exactly in the same manner. They move somewhat unrelated. So at least instead of this kind of movement of the portfolio, at least I have this kind of movement. Are you understanding? There is some if not a very extreme level of diversification benefit, at least some level of diversification benefit is there. I'm assuming you understand covariance, correlation, all you've done quants with me. Also, private equity funds, even in certain kind of transactions where you are not investing in a company or so, you could simply be acting as a broker or, being a part of the deal. So let's say two companies, let's say a private equity company is being split into, let's say a portfolio company is being split into 2 parts, and one of the parts you're getting it sold off to another investor. So there could be a divestiture, there could be deals, there could be buyouts. It's possible that you may not be investing in a company, but you have facilitated a trade, a deal, a sale of a company, a merger, acquisition, something like that, and you get fees or commission out of that. So that is also an advantage, that is also a benefit. Basically, you might be a part, because you're in the fraternity, you're in the zone. You are evaluating companies all the time. So you might broker a deal between 2 companies or so. You might be a participant in a deal or so. So you would be getting fees from that as well. The risk, obviously, private equity risk is higher than equity. Standard deviation of private equity is higher than that of equity. Risk is higher. That's why you're getting higher return. There is something called survivorship bias and backfill bias. Now what happens is, a very simple example would be, everybody talks about the, the startups that have succeeded, the unicorns that have gain that kind of market cap and all, but people do not talk about or are not even able to count the number of startups that fail, because most of the startups won't even report. Say for example, I'm analyzing the startup space of India, and I see which are the startups right now and what is the return they have generated in the last 1 year. Don't you see that automatically all the startups which started in the last 2 years, 3 years, 4 years, 5 years and shut down, they are not even available today in this year? I have not incorporated their losses in the calculation. Had they been successful, they would also been a part of the startup system today, of the startup ecosystem today. The problem is my data is biased towards the survivors. If you're looking at a venture capital index or something, you ultimately include the returns of those startups that are successful, what kind of returns different startups or different VCs or different funds are generating. Ultimately, there is a survivorship bias. Your data is biased towards only those survivors, which is very obvious and very easy to understand when you're looking at the venture capital space. Even if I calculate returns, even if and there is no disclosure requirement, there is no reported data. Like at least for listed equities, shares and all, I have so much of data on BSE, NSE, stock websites and all, because they mandatorily have to provide a lot of disclosures. But when I'm looking at the startup space, we do not have mandatorily disclosures and all. We have a lot of databases and all that have come up today, but that is also very incomplete and a lot of biases, because also it is very difficult to value a startup because they don't have any listed price or so. So how do you do the valuations? Valuations also turn out to be very, very upward biased and all, overvalued and all. So private equity, there is a major survivorship bias because your data is biased towards the survivors, the ones that are surviving. The ones that have shut down, you've probably not even included those in your calculations. That is a major problem. Second is a backfill bias. So say for example, when would a startup come into the news and suppose I'm constructing an index. Let me give you an example. I'm constructing an index where I'm trying to see how the startups have been performing and what is the return that the startups are generating. Obviously, there is no data and all available. So whatever returns that startups are reporting, I'm allowed only to include those. Let's say, for example, a startup started 5 years back. The first 3 years or 4 years, it was struggling. Obviously, it was not going to report its earnings, because obviously when you're struggling, you also need to attract investors, etc. You will not be reporting your earnings at that time. In the 5th year, you became very successful. In the 5th year or the 6th year. Now you reported your last 5 years worth of data. Because now you have, in the 5th year, in year 1, 2, 3, 4, the startup did not report any data. My index did not report that, include that data. In the 5th year, you have included last 5 years worth of data. You have reported 5 years worth of data. When I include that startup will also, I will also include that last 4 years worth of data. That is called backfill bias. In 2022, I am reporting the data from 2017 to 2022. But in 2017, 18, 19, 20 and 21, I did not report that data. Suddenly today, I have included that data. Suppose when I'm looking at Nifty's performance, let's say you are going to be looking at the stock's performance in Nifty and all. No, usme nahi hoga. No, forget it, not that example. You understood backfill bias? So, and who will be reporting these data? Who will be reporting the past data and current data? The ones who have become successful over the years, 4 years, 5 years and all. And suddenly I'm going to incorporate their entire history of data, which was not available earlier. There is a backfill bias. The private equity does not have listed prices. So private equity companies, the portfolio companies, they keep on doing valuations on a regular basis. They keep on doing valuations using what? Appraisal method. So they have a valuer, they will do the appraisal, they will do the valuations on a recurring basis, maybe a quarterly basis or so. It is possible now, because say for example, the investors are investing in a PE fund. If somebody wants to withdraw their money in the 2nd month or the 4th month or so, you cannot say that you will have to do the valuation of all the portfolio companies. Somebody wants to withdraw their money from this PE fund. If I want to withdraw today, after 15 days, second investor wants to withdraw. After another 35 days or 40 days, another investor wants to withdraw. On the date of withdrawal, you'll have to do the valuation for these companies. You can't say, okay, I will sell this company and give you the money back. First of all, you may not even be able to sell the company immediately, because they are illiquid companies, they're private investments and huge investments. It will take a long time for you to find the strategic buyer, make a secondary sale or something and sell off the company, right? Following this? So when I'm looking at, when any of the investors want to withdraw the money, I'll have to do the valuation for this one. I'll have to do the valuation for these portfolio companies and all. And these valuations are not available in the market. They're not listed prices or something. So what do? You'll have to do appraisals and all. You do it on a regular basis. Again, what is going to happen, just like your real estate index, you will have smoothening happen, because actually you're not able to sell startups on every 20-day, 30-day, 40-day, 50-day basis. It takes a long time to sell them off. And the prices also move in an extreme manner. They may not be increasing every day in a gradual manner. So maybe a startup is over here and right now it is flat and suddenly the price increases. But when you are doing valuations, you gradually increase the prices over time, because you're doing regular valuations and all. You're again smoothening the returns, you're revaluing. They're revalued infrequently. They are not sold. You don't have so much of trade. You don't have the startup companies and all being sold very often. But you revalue them. Same as similar to your appraisal method and all. So when you do that, you're ultimately smoothening the values. Your standard deviation and correlations, etc. understated. You understate risk. You overstate diversification benefit. Tell me, following this? Next is when you're looking at private capital, that is private equity and private debt taken together. Advantage is one, you have variety of investment opportunities. You can invest in a startup, an early stage startup. You can invest in a public company and take it private. So see the level, see the range of companies, from one of the smallest, nothing, a company at an absolutely nascent stage to something that is already listed. So the range of companies that you can invest, public to private, you can invest equity or debt, convertible debt, mezzanine debt, etc. So there is too much of options available to invest. There's a huge universe of possibilities in which you can invest. Return of private debt is obviously more than public debt, because private debt is less liquid, public debt listed, liquid relatively more. So obviously private debt is going to get an extra return because of the liquidity risk it's taking. It is going to get liquidity risk premium. It is going to get liquidity risk premium, because if I take additional risk, I deserve additional premium return. And you can call it a benefit because there is a control factor involved. There is active involvement in operations of portfolio company. I've already told this, that you get involved even in debt, even in equity. You are a part of the management. You will sit on the BOD. You will guide the startup. You're going to be revamping the LBO. So you will be very emphatically be responsible for influencing decisions of the portfolio companies, of the companies that you've invested into. That gives you a sense of control. You can move things the way you want. So active involvement in the operations, that gives you control. The advantage is basically the control. Tell me, following this? The disadvantages in general, these advantages and disadvantages are for private equity and debt both. This is only for private equity. These are common for private equity and debt both. That is why private capital, the liquidity on an average is very low. That is why you get that liquidity risk premium and all. There is a major risk in two ways, understand. The first risk is to select the P fund correctly. Which P fund to invest? There are a lot of P funds. So I want to be able to choose the P fund correctly. And we understand in the alternate investment space broadly that the top quartile and the bottom quartile managers, there is a huge gap in their returns. It is not like the bottom quartile managers earning 12 and the top quartile managers earning 14% like in equity. The top quartile and bottom quartile managers, the gap is huge. Very significant basically. So therefore choosing the correct P fund, choosing the correct manager is important. So there is a risk of not selecting the right manager, not selecting the right P fund. That is the first risk. And the second risk is that the manager you have chosen, what if that manager is not choosing the correct portfolio companies and all, missed opportunities? There was this one statement I think Charlie Munger sir had made, that, or it was Warren Buffett, I don't remember because they're both partners with Berkshire Hathaway. So one of them had made a statement that, which was your biggest loss. So I think it was the missed opportunity is what they had mentioned. I think they invested into Apple also much later, and Apple is one of the largest holdings of Berkshire Hathaway. So what I'm trying to tell you is the missed opportunities, whether the manager has the skill for choosing the correct companies, to not letting go of amazing opportunities in terms of investments, and also there is a major risk. And overall risk is very high, because of which you're getting high returns. On an average, your risk is high. That is why you're generating higher amount of return. Tell me, comfortable? This is private capital for you.